moving on. Advantages of Reg A plus. I'm going to focus on the less obvious ones. Some of these are very obvious. Having liquidity, which I'll get into later, is obviously a good thing. So it's very flexible compared to many other types of offerings because you can literally go live with your Reg A plus and change the share price, change the valuation of your company as you go, and you within reason. And obviously, all of these things involve a process, but nevertheless, the ability to change the valuation as you go is very helpful because many companies, the maximum for Reg A Plus is $75 million per year. But you might file for up to 75 million, but you might only want to raise or need to raise 15 million. That might be sufficient, and you'd love to raise more if the process of the raise is going well enough. But you actually really doing this to raise $15 million. So if you establish a valuation that's consistent with that $15 million raise, and then have a great deal of success and want to raise more, you can raise the valuation to manage dilution as you go. That's helpful. And it also rewards the earlier investors for taking what is a bigger risk. Somebody who invests in the first week that a Reg A Plus offering is live is taking a bigger risk than someone who waits until the last week when the company's raised a large amount of money. It's less costly than an S1 IPO, than a conventional IPO, and it's also less time consuming. So the amount of comments back from the SEC are far reduced. The SEC seems to like Reg A Plus. We've had, I think, 4 of our customers get qualified in about a week or 12 business days from filing. When the SEC actually states going in that you should expect 2 one-month cycles where they'll have questions for you, and the speed at which you respond to each of those questions will determine how quickly you can be qualified. So getting through the SEC process in about 2 months is quite reasonable for uncontroversial, well-prepared offerings, and much faster in some cases. And having the ability to use a US GAAP audit instead of PCA or B is a nice advantage compared to a conventional IPO. And again, the SEC considers this a public offering, and we'll get into the listing options later. Up to 30% of the raise in a Reg A Plus can be selling insiders, be that founder members or old investors or relatively recent investors if they've exceeded their Rule 144 holding period, which is typically 6 months. I mentioned marketing is allowed. Some companies lend themselves, and that's where I think AI, machine learning, ChatGPT kind of businesses can really do well, which I'll get into in a moment. But the fact that you are allowed to market and that you can include marketing in your business on a daily basis, you can insert invitations for customers and partners to invest in the transactions that are occurring every day on your website. Very advantageous because it can significantly reduce expense. The liquidity options, I've mentioned that, I'll get into that more. And the fact, if you have customers, if you have fans, if you have transactions, as I mentioned, being able to leverage that cost effectively, that drastically reduces the cost of marketing. And there are many new business types that can exist now that didn't exist before. I've done another webinar, the last prior webinar to this one, focused on series offerings for companies that are doing collectibles, for example, collectible cars, collectible jewelry, art, things of that type, unusual investment assets that regular folks haven't had access to before can be offered in a Reg A Plus series offering where you might have 50 or 60 or 70 different subclasses of stock within one Reg A Plus, where the price is determined by the value of the asset and the asset trends according to the interest in it, for example, art. That category exists now and is doing very nicely, and it just couldn't have come to pass without Reg A Plus. So innovative new options that you didn't have before. I mentioned the flexible raise amount, that you can finish it early, that you maintain control of your company when you're raising money from private equity or venture capital sources. Entrepreneurs do run the risk that they'll be booted or maneuvered out of their own company. So having control over the raise is another advantage. And many people tend to think that if you're raising money that and you want to raise $40 million, for example, that you have to raise all $40 million before you can draw down from the proceeds that have been deposited into escrow. That is not the case. If you describe and position your offering as to grow the company, and you define to the SEC what the use of proceeds, and to investors what the use of proceeds will be in a smaller raise, then the SEC allows you to raise smaller amounts and to conduct escrow closes from the beginning. So that ability also to include in the filing that you will use proceeds from the raise to fund the ongoing marketing and other expenses of the raise is a big advantage. So from a cash flow standpoint, that's a lot more attractive. If you're buying an asset, if you're buying a business or a building, and that's $20 million, well, obviously you have to raise $20 million before you can sensibly deploy that money. In that case, you start funding all the expenses. But that's very, very few companies take that approach with Reg A plus, but that's obviously the case for an asset acquisition. And I mentioned $75 million a year. You can use Reg A plus for a secondary offering, less expensive than using an S3 for public companies.